Ilya Spivak in San Francisco, Dylan Radigan in Milan, taking you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. So if you're on the platform Tasty Trade on the website tastylive.com, welcome. Thanks for joining us. Come to the chat. Tell us what you're trading, how you're preparing for Powell's speech tomorrow. He speaks at 10 a.m. Eastern is when the remarks will be released. Of course, today we have a little bit more of that jiggle lower in tech stocks. More warnings, Meta freezing their AI hiring on top of Sam Altman's warning, on top of the MIT study earlier this week. But the big news is that Fed cut odds continue to decline ahead of tomorrow. What was a 100% shot of a September rate cut, according to the futures market, now residing closer to 73% last time I checked. So we're not going in head over heels expecting that policy is going to be loosened. PMIs today a little bit warmer. What does that mean for bonds? Bonds trade up following those cut odds, moving lower. Dollar bounces back. Oil higher. Very cryptic Truth Social post from President Trump comparing himself to Richard Nixon staring down his Soviet adversaries. Oh, maybe the Ukraine war is going to take a different tack than a peace summit in Alaska may have hinted at. Either way, though, Dylan, you were on Hear Me Out earlier. You say nothing could take down this market. The market's been taken down this week. Is this just
has it been taken down, or has it just been moderate? I mean, now we're getting into semantics. When I say, you're going to call this a take. What's the?
I was going to say, is this like a Monty Python, just a flesh wound, or
this is a 7-year-old with a knee scrape off of the seesaw? Get back out there, kids. Brush it off. You're fine. Just relax. We should be so lucky to get it taken down so that we can pick up a bunch of AI names. I think that, listen, one, this is not a takedown. Two, this could be foreshadowing of a takedown, right? Like takedown sometimes, we may look back at this in a few weeks and be like, ever since Sam Altman, sort of threw a little ice water on the AI thing, and then Powell came out and threw a little ice water on the Fed rate cut expectations, things got real squirrely. But I would say it's too early to say that at this point. I would say this is just a very tempered pullback of positioning, rationally so, in advance of Powell, who could reduce rate cut expectations further through the tea leaves tomorrow. And for sure, the Altman AI stuff, because the market is where it is exclusively, in my opinion, not exclusively, but largely because of mega optimism about the technology piece of this, and to the degree to which there's any tempering of that, everything else has to come back a bit.
Ilya,
it all makes sense to me, I guess I would say, but I wouldn't say that it is an indication of any consequential shift in overall expectations.
Ilya, I would generally agree. The positioning isn't catastrophic. We've been talking about the level to look at in the S&P. This is not a confirmed top. We're not there yet. We're down a little. If we compare this to the pullback that we had in late July, that pullback was about, 3.5% peak to trough. We've now had a pullback peak to trough of 2.25%. So this is not like a scary, holy moly, we're going to have a big sell-off like February to April kind of thing yet. I don't think that that's off the table by any stretch, but that's not what this is right now.
When does it become that?
For me, the line in the sand is about 62.40, 62.50 on the S&P. That's basically lining up with the lows on August 1st. I think there's a kind of horizontal shelf there, going back to even early July. So, like, if you put a horizontal line at the July 7 low, I think you basically see it. And that's, you and I have, I think, the same line. I think that's the line in the sand. That's where you would have rounded off a top. And then you have something bigger.
You mentioned the PMIs this morning. Those didn't cause a problem. In fact, they moved in quite the opposite direction they beat expectations roundly.
They beat
Manufacturing
expectations,
PMI,
and overnight, by the way, Australia beat expectations, Japan beat expectations, the UK beat expectations, the Eurozone numbers beat expectations. All of the PMI roundup, not just the US, all of it was a little bit soggier on services, a little bit better on manufacturing. Overall composites higher than expected across all of it.
Yep, Dylan, manufacturing 39-month high. Chris Williamson, who's the chief economist there, points out that the PMIs right now are pointing to a 2.5% annualized growth rate, up from the 1.3 expansion rate seen over the first 2 quarters of the year. If we're not getting a recession, doesn't that buttress your argument that there's really no reason to be so concerned about what's happening with Powell's speech? If it's a dip, it's an opportunity to buy.
I mean, yes. I mean, that's why I've sort of maintained my Mike Butler-based optimistic sort of worldview. I don't see evidence of a meaningful economic slowdown. I don't see evidence of a big negative economic event. I just see sort of hand-wringing about economic data churn. And for sure, I'm actually more concerned about inflation, because for me, I don't understand how you can raise the price of all imported goods by 10 to 15% and not have that make a permanent influence on pricing. Like, how is the cost of everything not higher? How is inflation transient when the overall cost of transacting has been increased on such a fundamental level? That's actually my biggest economic concern, or concern about the economy, I guess I would say, is in that regard.
Can I point out what's
together?
Can I point out what the economist of the PMI report says here? Companies have consequently passed tariff-related cost increases through to customers in increasing numbers, indicating that inflation pressures are now at their highest for 3 years. The resulting rise in selling prices for goods and services suggests that consumer price inflation will rise further above the Fed's 2% target in the coming months. Indeed, the combined with the upturn in business activity and hiring, the rise in prices signaled by the survey puts the PMI data more into rate hiking rather than rate cutting territory, according to the historical relationship between these economic indicators and FOMC policy changes. So Dylan, we talk about running this thing hot. Deficits are up. The inflation data are at a point where the Fed would not be considered cutting, but for the fact that the composition of the Fed board's changing, and there's a great deal of political pressure given some of the top lines. Now, I would make the cogent argument that what's happening in housing, in jobless claims being at a 3-month high, in continuing claims having risen to their highest level since November 2021, with basically the southern portion of the US geographically experiencing a falling out in the housing market, you could cut. There are reasons to cut.
What would be your top 3 reasons to cut?
Housing,
you're a member of the board of governors and you're advocating a cut in September and you're in the boardroom. What make your case?
Housing, jobs, and then broadly speaking, labor market composition.
So
because of
you're saying a little bit of a mushy labor market and the overweighting your whole the disproportionate healthcare role in the labor mix.
Well, this is the graph that we showed yesterday, Dylan, right?
Mm-hmm.
Healthcare, right? Healthcare has added 55,000 jobs in the most recent month. Over the past 3 months, healthcare itself has added 150,000 jobs.
Mm-hmm.
When you drill down, it's really healthcare is what's driving social assistance, healthcare. These are very low productivity industries,
mm-hmm.
right? These are important industries. We don't want people dying or suffering, but in terms of where the job growth is right now, they're not in the highly productive areas of the economy. So knowing that, seeing that claims are up, I know a lot of the claims are being driven by what's happening in the DMV area following the federal government trimming, and Maryland, Virginia, Delaware, right? You're seeing those are the states that are providing the bulk of the jobless increases right now. But I would argue this. I would argue that we don't have jobs growth in the meaningful areas of the economy that matter all that much. not in professional business services, manufacturing net down, wholesale trade, retail trade is barely up, but transportation, I mean, forget government cuts. So what? That's nothing here. It's just, it's moving in the wrong direction. So I'd point to that. I would point to the fact that the housing market's in a really bad spot for most of the country. Those would be my two prime reasons. And I look at the immigration.
And then why are you, and then what's your count? And then I would say to you, well, I understand your point, counselor, but the labor market is relatively fine. There's no big evidence there. And we have we have substantial inflationary pressures, the consequences of which we do not yet know because of the administration tariffs. And shouldn't we be cautious before making money cheaper at a time when inflation is already sort of on the threatening to emerge as yet another consequential issue, especially as we go into 2026 and as these tariffs get implemented across the board. Maybe we should take a little bit more of a wait and see attitude before we go around making money cheaper. Good sir.
Yeah, no, I think that you could make that argument too. I'm not denying that. You could really go this both ways. What do you care more about? Do you think that inflation is transitory? If you do, and you think that's the likely outcome here, then you're looking at the labor market and you're looking at the housing market a little bit more heavily in your weighting. And if you don't think inflation is transitory, then you say housing market and labor market weakness or jitters be damned. We can't cut rates when inflation's pointing up because this isn't going to be transitory. So pick your poison. What's better for the stock market or the bond market?
This is where you
Break
have
the tie, Ilya.
This is where you currently have the Fed where it is. And let's sort of re-anchor ourselves in what the Fed itself is saying. The Fed is saying that there's been a slowdown. So that the economy is slowing is not a controversial thing. The PMIs here from S&P, they're optimistic. These numbers have skewed optimistic. ISM numbers for this same period, we don't have them for August, but in July, we had very strong S&P global numbers, and the ISM numbers were awful. They put the economy at standstill for the same period. So there's some...
You say the same period? You know what this reminds me of? Look where the PMIs here on the chart. This is for the composite output. You think about late 21, 22.
Yeah.
And then you go where the inflation numbers are pointing up in 21, right? Think about composite PMI output here next to CPI.
Yeah.
This is like, are we going back into the vibe session?
Well, so this is where it gets, this is
where we
where
just
it
muddle
gets
through and things feel shitty.
This is where
I feel like we're going.
But I'm saying this is where it gets interesting, right? The market reaction today, if you open the S&P 500, you put it on a 15-minute chart, and you put your cursor on the PMI release, the markets are telling you what they think of it. They don't like it. That surge you get, that's after. That's the PMI release. The markets then even out because the event risk is out of the way, and then you basically settle exactly where the PMI landed you. You sell off all the way into the PMI. The PMI is the crescendo. The markets then kind of seesaw as the event risk comes off the board. Everybody takes their speculative bets that maybe they had on the PMI off or put them on or whatever it is, and now we're looking at Powell. But the smooth trajectory this morning of saying markets open, they open down, they trade down all the way into the PMI comes out, it's better. The market says good news is bad news. And then everything essentially gets choppy and settles into the close as everybody
10 o'clock,
sort of
10 o'clock we had
figures it
existing
out.
home sales. Existing home sales beat today, which was a nice little development. But after they
That
beat,
didn't save any, and that didn't save anybody.
no, but I think right now, just watching this at the margins, right? we're still holding on to some good news is good news kind of situation, right? We really don't want the economy to confirm the belief that we're teetering into recession and therefore the rate cuts are
No,
necessary for such a reason,
no. But the
right?
markets clearly seem to think that.
Yeah. But it's a different setup, right?
Here's the upshot.
What's the
that
upshot?
I thought was the most kind of pointed for me. We went down to 42 basis points for this year, but we went up to 72 basis points for next year. So the markets looked at everything that came out today and said, this means the Fed is going to do less now, maybe even less than they were saying in December and March and June, which was all 50 basis points. Now, okay, maybe not the full 50, though the markets are still leaning there. But they've taken certainty in 50 off the board. But next year, we're out to almost full certainty of 3, and the Fed is still at 1. So the markets want these cuts. They want them because they've been looking through this inflation for months now and saying the problem is actually disinflation because the tariffs. And once the tariffs work their way into the economy, they're going to be more a disinflationary force because they're going to hurt growth than they are going to be an inflationary force because there is a one-time lift in prices that then goes into expectations. The expectations extrapolate. This is the thing the Fed is concerned about. That basically what could be a one-off adjustment is going to become a lasting adjustment, because if you don't do anything about that adjustment, then people are going to say, oh, well, then prices are going to rise like this going forward and forward and forward and forward, and modulate their consumption accordingly and modulate their investment accordingly. And then the inflation gets stuck in expectations. And then it's impossible to get it out, but with more tightening at great pain, as we learned in 2022. So when you read the FOMC minutes and you go, they're worried about asset valuations. They're worried that the weakness in the labor market isn't real, that it's just immigration and not job losses as such. That nobody's firing anybody per se. They're just not hiring because there's no one to hire. Because immigration. The tone of all of this is very wait and see, but the markets want their cuts. That tells you the markets see through this near term back and forth and are looking further downwind. So this to me makes the September rate cut kind of a whatever situation, unless, of course, it doesn't happen for some reason, in which case I think everybody is going to freak out. I think the object of speculation isn't that. The object of speculation is what happens next year. And the markets want 3, and the Fed is giving them 1. That makes the SCP in September, the Summary of Economic Projections, the real mover. The Fed is either going to line up with the markets or closer to the markets, or it isn't. And what we, I think, are listening then for when Powell speaks tomorrow is some sense that more urgency about the business cycle has materialized. In June, they said, okay, maybe uncertainty is diminishing. In July, that they took it back and said, no, it's not diminishing. Everything is uncertain. Everything is still very rocky. We don't know. In September, it'll be, well, has the uncertainty diminished? Do you have a better sense of what you need to do? Are you paying attention? And if the sense is kind of vague, and I think Dylan is right, Powell's going to say nothing. He's going to do the same song and dance. In the immortal words of one Curtis Jackson, the same old two-step. And the markets aren't going to like it because it won't endorse their 3 cuts for 2026. And that'll be the story.
While we're still on this topic, Dylan, I just want to point out that Powell's speech is a reaction to, or at least in reference to, what the key theme of Jackson Hole is this particular August. Jackson Hole's theme this year is labor markets in transition, demographics, productivity, and macroeconomic policy. That sounds like, it seems like if Powell is going to be making any comments that are in line with the theme this year, the stage is at least set as a backdrop. This backdrop is not inflation. The backdrop is not changing the Fed's framework around inflation in an era of north of 2% inflation, right? He's not going to be rolling out a 3% inflation target tomorrow. The real focus is on labor. I couldn't help but notice that one of these preview articles I was reading, it said tariffs and an immigration crackdown have slowed the economy, grinding down job growth and threatening to increase unemployment. 2 members of the 12-person committee that votes on monetary policy have already called for lower rates, and financial markets are betting a rate cut is coming. What is more important long term? Does the Fed care more about inflation or the labor market? Do you think, given everything that we've seen post global financial crisis or COVID, and more importantly, does any of that matter once Powell's out of office and we have Trump's appointed Fed chair?
Are you asking me?
Dylan, first.
I think inflation is the number one thing. So I think once Powell's out of office and Trump's, I think inflation is the number one thing. I think that became clear coming out of COVID. I think that the fact that Trump's going to appoint a lackey to be the next Fed chief will only make inflation fears much worse. Because if in fact Trump is successful in appointing someone who is indifferent to economic reality and operates in the same way that the rest of his cabinet operates, I'm thinking about Pete Hegseth. I think that putting someone in charge of the Federal Reserve who's willing to just do what the president says, no matter what the economic data is going to be an inflation catastrophe, which might be Trump's legacy, is total annihilation of the US dollar through catastrophic economic policy, which I'm hopeful doesn't happen. But I actually think that the idea of that inflation is the number one concern in the short and intermediate term. And the idea that Trump is going to implement a loyalist who will do whatever Trump texts him to do with interest rates is going to be really, really bad for inflation and ultimately drive bonds much lower and rates higher. Even though they're going to cut rates and the market rates will go up, and it's going to make them insane.
And make him go insane. Okay, so Dylan, let's just what are the odds? I don't think that Trump's firing Powell, but just game this out. There has to be some odds where Powell doesn't come out and tell Trump what he wants to hear, and Powell is summarily separated from his employment at the Fed. If Trump's going to rage fire Powell, is it tomorrow or is it when he doesn't officially cut rates in September?
Is what going to happen?
Let's say Trump's going to fire Powell at some point. Just game this out.
Throws a hissy fit, let's say.
If Powell comes out tomorrow and says no rate cut in September, does Trump try to remove him before the September meeting so rates can get cut? Or does he?
No.
So what's the play here? Does he appoint a shadow Fed chair? Does he announce Powell? What does he do if she doesn't get those cuts? That's my sense, because I'm thinking about Fed independence here is a theme likewise of this Fed meeting, if we want to admit it or not.
I don't think Trump's going to get mixed up with Fed independence. I think that, I guess a lot of people have lost a lot of money betting against the excessive lengths that Trump will ultimately go to, but I just don't see where he's going to actually do that. Like, let's assume, first of all, Powell's going to cut rates. So this is going to be a non-issue, in my opinion. Second of all, if Powell doesn't cut rates, there'll be lots of rhetoric. Oh, the man's an idiot. The man's a fool. The man's, all sort of negative commentary. But I do not believe there'll be any action of consequence on that. I think that there's just a plan to appoint. Again, it doesn't matter who the Fed chairman is. What matters is the actual economic reality. Like, the Federal Reserve is not just some random group of people that are doing whatever they want. They may be doing a bad job at times, but they're doing the best job that they can to interpret the economic data that's in front of them in the way that to the best of their ability to try to manage for currency stability, inflation stability, growth, and labor market stability. I mean, this is their mandate. And that's not going to change. And in other words, if you were to change the administrative culture of the Federal Reserve and detach it from economic reality, the bond market will put an end to that super fast. And that I just don't. I'm even with the most loyal. Even if Trump made himself the chairman of the Federal Reserve, I believe that the bond market would temper his ability to do anything, because I don't believe Trump wants to supervise a bond and currency catastrophe. So I don't think it matters as much as people. I don't. My point is, I don't think it matters as much as you might as we might think.
Ilya, is this a discussion like akin to me as a New Yorker considering buying volcano insurance?
I mean, so they want
waste of time, money.
They want to talk at Jackson Hole about labor markets and demographics, right? What are they saying? What is this a conversation about? Is it really a conversation just about labor markets? Of course it isn't. Because what are we talking about? This is the oldest conversation now, right? Chris, you and I were screaming at the top of our lungs in 2021. What are we saying inflation is transitory?
Oh, I got to be intellectually honest. I was not in that camp initially. I was very much in this is transitory, it's supply chain driven, which it was.
It was, but not in full.
Not in full. No. So I wouldn't say that I was fully right. I was late to that party. But I was also
yelling. I was yelling from the rooftops, if you recall.
But my disconnect was at least I was
inflation reasons.
I was at least going into that year, thinking that the Fed was raising rates. I didn't think inflation would run that far, but I was long energy, which got the tail into the Russia-Ukraine war. Right. And I was short tech stocks, like heavily short ARK. So it was real for me, at least. I wasn't right, but I had the right trades on. So it wasn't terrible, even though I finally came around to, okay, 9% inflation, maybe not so transitory, a little too late.
For me, it was very, very obvious that there was the supply chain disruption, and that was one thing. But that also, there was a demographic change that started in 2017 and was very much accelerated by COVID, which was the leaving of baby boomers from the labor market, the mass retiring, just because people got of age, of the biggest cohort demographically in the labor market. And that also both sides of the political spectrum, as evidenced by the 2016 victory for Trump, the way that Bernie Sanders did so well, that both sides of the spectrum, the way that Biden was governing and didn't take away many of the tariffs, that globalization had become a bad thing on both sides of the political spectrum, no matter how stupid that is. That it lost favor. And that people lost sight of the idea that the problem with globalization isn't globalization. It's the handling of it and its smaller side effects for a minority of people by callous politicians. And that what would happen then structurally is there would be deglobalization at the same time that the labor market would get much tighter. And that what this would do is it would increase inflation structurally. That everything would become more expensive because the cost of doing business in a deglobalized world is more expensive. And because there is a labor shortage, because fewer people are there, because the generations following the baby boomers are just smaller. And there's not that many people to take on those jobs. So all of this was inflationary before COVID. It was a slow-moving ball before COVID. COVID made it a very fast-rolling ball. And so it was very obvious to me then already that the Fed needed to go on a massive rate hike cycle to put this thing back in the box. They did, and it worked for the most part. Those structural issues have not gone away whatsoever. None of that changes with tariffs or no tariffs, pandemic or no pandemic. All those things continue. Those are long-term forces. So when the Fed is going to go talk about the demographics of the labor market, they're talking about inflation. When the Fed is going to go talk about all of these things, they're talking about inflation. And if the speech that Powell gives is going to be, look at these long-term forces, they're inflationary. We've been talking over here at the Fed for years about maybe the neutral rate is higher. That is the point where incremental jobs growth is going to be inflationary if only it's one more job, the kind of neutral, maximum employment with price stability. That whatever that interest rate is now structurally higher and will be structurally higher because the world is different. The demographics of labor are different. The global architecture for commerce is different. That's a speech that says, yeah, okay, maybe we'll give you some rate cuts right now since you're all so hopped up on them. But if you're expecting a big easing cycle, there's a bridge I have to sell you. And because the market is so focused on not this year, not these cuts, but next year's cuts and the cuts after that, and because there is a deep disconnect to the tune of about 50 basis points between the Fed and the market on this score, then the market is wrong-footed. And we see from the price action today, they want those cuts.
We did have earnings results come out for Intuit. They own the lovely company Credit Karma, if you didn't know that. Total revenues beat, but not as much as expected. EPS was up. Guidance looks good. The stock is getting pummeled here after hours regardless, minus 6%. Credit Karma lagging in the revenues. They're citing higher costs for labor and other input for anything they're doing, which is the theme here, because when you put 10 or 15% tariffs on things, things cost more in general. Dylan, in this world of everything pulling back here that's related to tech, that includes our beloved Bitcoin here. I say our beloved because I know how much you and Ilya enjoy it. I'm just merely a spectator. You guys are the true aficionados, our little
We're the real crypto believers.
My little Satoshis, as I like to call you guys endearingly. Oh, Satoshis. This is the lowest it's been since
Dylan
early
and I
July.
Are starting a band with that name. I don't know if you knew.
And we're going to issue a meme coin based on
That's
the
right.
band.
That's right. You can only buy tickets with the coin. It's going to be a great
you need little
pyramid
Satoshi
scheme. We're going to make a gazillion dollars.
Yeah.
Come see the little Satoshis. Okay. 112,000 here, down 2% nearly today. Is this the end of the bull run? I can't help but notice we're starting to lose the uptrend here from the April lows. It's not feeling too hot this week.
Well, let me ask you a question, Mr. Question. What dictates the price of Bitcoin? What are the top 3 variables that dictate the price?
Sure that there's 3.
When your idiot neighbor makes more money than you. So jealousy.
No. So I think
greed,
that's the one.
Avarice.
I think that's the one, but I think there's only one.
Distrust.
In other words, you asked me, you're like, how do I have a real opinion on the price action of Bitcoin when I don't really understand why Bitcoin has any value at all, let alone why its price should be higher or lower, other than I'm jealous because other people made money in it, and now I'm going to do it because I want to make money in it. And You know, I mean, there was a moment where there was a lot of rhetoric, all this blockchain rhetoric a couple of years ago, and the applications of record keeping and cross-border transactions and verification, validation, transparency, all the all that.
Smart
And I don't hear that.
contracts.
Yeah, smart contracts. You can sell, the whole title transfer, sort of all asset transfer will be all record keeping for all assets is going to be on the blockchain. Okay, and that's why you need.
RFK Jr. was saying he wants to put the federal budget on the blockchain, whatever that even means.
Exactly. But I don't hear that so much anymore. So I just like, what is the basis of the value of Bitcoin, Mr. Vecchio?
What's the basis of the value of anything?
Oh, well,
That's
the
my
base
kind of
the
question.
value of equity is a discounted cash flow of the future earnings and enterprise value of an ongoing business concern that sells a product or a service. The value of a bond is a discount.
Well, is that true?
Cash flow.
Palantir has a 200 price to sales ratio right now.
Yeah, because
Amazon
people
doesn't
are
have that.
very
Well,
optimistic.
the short-term speculative forces are what they are. I mean, our good friend that we maybe don't know directly, Bert Malchio, would tell you that even though he wrote the book A Random Walk Down Wall Street, he would tell you, even he would tell you, shorter term there is speculative fuzz. That's why you don't try to guess.
It's just fundamentally as traders, we are to understand that Burt and Malkiel's view on markets is idiotic. Because if it's just a random walk, then what are we doing here?
Even Burt Malkiel will tell you that he doesn't fully believe what that title implies.
Yeah.
This, if I might say, is a disingenuous assertion to even suggest that the absence of any underlying activity to support the value of Bitcoin is comparable to any publicly traded fixed income or equity security.
I totally
read this instead. This is a response to Burt Malkiel's book called The Non-Random Walk Down Wall Street.
Now you're just being evasive. This is now a non.
No, I totally agree with
evading technique. I call
Dylan here.
evasion.
Totally agree. I mean, money is a
him that I'm being evasive.
No. The idea that Bitcoin has what Bitcoin has going for it isn't necessarily different from other assets, but other assets are in part speculative fervor, in part fundamental value. Whereas Bitcoin is only speculative, and crypto in general is only speculative.
Excuse me.
Okay, so the cost to mine gold right now, roughly speaking, is between $1,276 and $1,388. Obviously, gold prices are trading at $3,381. In electricity costs, the cost to mine one Bitcoin is about $11,000 at the cost of 10 cents per kilowatt. So clearly, both gold and Bitcoin have valuations that are well in excess of what their value is in terms of actually pulling the substance from the ether and bring it into the tangible world, into the world in a usable form of function, right?
But I mean, I would say that's also why I tend to not have an opinion on gold price. For the same reason I don't have an opinion on Bitcoin price. I don't understand. I mean, because the value is basically gold that has obviously a vastly longer history. How about this? Bitcoin and gold are effectively derivative prices of perceived alternative currency risk, meaning as people's confidence in fiat currency waxes and wanes, gold and Bitcoin are a derivative of that. Like that would be my best answer for my own question would be Bitcoin is a digital derivative of sentiment around the integrity of fiat currency.
Do we think that the integrity of fiat currency has improved meaningfully during this recent pullback in Bitcoin of the last 10% or so?
Certainly the yield appeal of fiat currency, and in this case, we're talking about the dollar because that's obviously the dominant fiat currency, needless to say, and by mile so long that it's not even a fair comparison, even to the likes of the euro. But the return on holding fiat currency has very clearly improved. Even just today, Fed rate cut odds came down, yields came up, Bitcoin came down. The same way that you might expect a non-yielding asset to behave in an environment where alternatives to fiat and yields are going together in the opposite direction. I mean, gold was down today. That's another anti-fiat, anti-interest rate thing.
But silver was up.
Silver is an interesting character here. I for one am looking at silver today, and even I'm trying to wonder what in the world silver is doing here.
It really
Because
wants to rally.
It seems to, yeah. Because when you look at gold here, you go, okay, well, that makes sense. And you look at Bitcoin, you go, oh, that makes sense. Stronger dollar, stronger yields. That's kryptonite for all this stuff. And then to your point, silver goes, I see your higher yields and your stronger dollar and your stocks sell off, and I can't be bothered. This tells me that, either one of Dylan's Hunt relatives is afoot, or this thing really wants to rally for some reason.
I would prefer the latter scenario, but volatility is starting to creep back up. We had negative IVRs as we turned through the middle of the month at the start of the week. 2 days ago, we had a negative 2.859 IVR. Now we're back up to 6.9. Gold, similar. IVRs were bottoming out in the 10 at 10, and we've started to turn back up now into the mid-teens. That's a reassuring sign from the metals perspective, at least. Still leaning long silver, frustratingly gold longer term stuff is fine. The calls have been decimated. The directionally neutral stuff, okay, because we're just grinding around 3,400. Any shot that we break this trading range tomorrow, Ilya, in gold or bonds or really anything? Equities obviously have, I think, the greatest potential to give you a directional move around Powell. But when I look at notes or any of these guys, the price feels kind of right in the short term.
Yeah, I mean, I think when you look at all of this stuff, in particular in the bond market, you kind of see the sort of stasis you also see in gold broadly since April. And you sort of get the sense that what the markets are doing is they're waiting to digest, much as the Fed is waiting to make up its mind as to what's going to happen and as to how much you're going to have of a tariff inflation versus growth scare, and then what there is to do about that on policy. I still suspect that on a day like today, when the data is good, the market doesn't like it, but it doesn't like it because yields are up, I suspect that you're going to have a long end that rallies, because the longer the Fed dithers, the more the cuts go down curve. And I think that this kind of begrudging up move since mid-May or so, it's slow. It looks almost sideways. But if you look closely, especially at ZB, you have a higher high and higher low dynamic here. The trend is up. It's very slow, very shallow, but it's up. And so in my mind, that's the path of least resistance. And it's not because the Fed is going to cut with reckless abandon. It's because they're not. And so the curve is going to twist, where the cuts are going to go into the back end of the curve.
Well, ZB basically hasn't done anything this year. It opened up the year right at 114. We're at 114.03.
Yeah.
It's unched. I suppose that's the good news. Rates haven't really evolved all that much.
I mean, I would argue not to pick up a piece of a conversation from 20 minutes ago,
Go
but
for
let's say Trump is successful in either bullying Powell, which is unlikely, marginalizing Powell, which is also I think unlikely, or in appointing a spineless lackey as the new Fed chief. All three of those outcomes are going to be, I think, just terrible for the dollar and the bond. And I think they're going to have the opposite effect of what he would. I think that it'll cause the dollar to go down and rates to go up. Even if they could take rates to zero, but if they took rates to zero with a Trump loyalist like a bunch of idiots, the bond market's not going to recognize that. You just have a goofy looking yield curve at that point. I just don't know how much. I think Trump is delusional about the fact that he thinks that rates are dictated by a person. I mean, this is where I'll just go full Tom Sosnoff.
Can't they be though? Can't they?
No,
Can't they do yield curve control?
The market dictates rates. I mean,
Sure,
you can go for a full Erdogan, which I mean, I guess but I just don't see how, with the reserve currency being what it is and the dollar being what it is, how Trump can go full Erdogan.
Can he go? Can he go full Japan though and do yield curve control?
I don't think. I mean, I don't think he can. The amount of liquidity and the nature of the reliance that the world has on the stability of the U.S. financial markets as being a market-based system, not a centrally controlled economy. I just think anything that moves to those central controls is catastrophic and the market will puke it all up and it'll be gone. It'll be done in a day. If you thought the tariff reaction was bad, wait till you get a handle on a rate loyalist doing irrational things with rates that are completely disconnected with economic growth and inflation, and that are just disconnected to whatever ambient laden text message came from the White House on a given night. I mean, it's ridiculous.
Ilya, though, I'm sure you've read too that people are somewhat worried that if you get a heavy Trump loyalist in the Fed, they're going to work hand in glove with the Treasury, given the Treasury issuance and the Fed's balance sheet. You could tinker with the runoff of QT, and you could effectively implement yield curve control. Why aren't you worried about that world?
I'm not, because I think what we learned in April is that this administration is not immune to bond market discipline. And frankly, I view the entire stocks rally from the lows in April up through the peak, basically this month, as reflective of the idea that the markets came into April with the thought, oh my God, what we're going to do is destroy the dollar and destroy the Treasury bond because we are going to unglue their credibility underpinnings.
We've done it before.
Oh, sure. We've done all kinds of things before. We were the last major economy to have a central bank. And it's because the era, the free banking era before the creation of the Fed was such an enormous disaster that even we were convinced in all of our NIMBYism as a country generally, like leave us alone, get the government out of here, don't control the money, dog eat dog. It's the American way. The free banking era was such chaotic insanity that even we were convinced to belatedly get a central bank. This is a different situation now. I think we've done all kinds of crazy, stupid things. But I think what we learned in April is when it looked like the dollar recycling mechanism and the Treasury underpinnings that come from that and the borrowing privilege that the U.S. enjoys because of that, when that was legitimately threatened, and for a while there, bonds and stocks and the dollar were all sinking together because it looked like the U.S. was going to literally self-immolate its own financial system, the president came out and said, "Ooh, looks like we're getting a little yippee out there. Let's back this whole thing up." So I think we've learned that this administration is not immune to bond market discipline. And if we were to get anywhere in the vicinity of what we're talking about here, no matter how many stupid people in the administration are wistful for the gold standard or strong-arming the bond market or some other idiotic idea that everybody's learned decades ago doesn't work and is terrible for everyone involved. I think when it comes to the president, he likes lower rates. And when he creates chaos in the bond market, term premiums go up and rates go higher instead of lower. I think that the president's instinct, rightly, is to say, wait a second, this is the opposite of what I wanted. Let's throw this thing in reverse.
Dylan, is it as simple as this?
90-day pause.
Dylan, is it as simple as this? CNBC, Bloomberg, Fox News, all reporting that Trump has purchased more than $100 million worth of corporate bonds since he took office. Is he just talking his book?
He's talking
because
his book,
obviously
baby.
Lower rates are going to help his bond position.
I mean, that's a better argument. That's a better reason. I mean, that's a more likely reason for this president than anything else. You know, his indifference to everything else other than his own self-interest has no limits. And so, if anything, it may simply be to try to juice his bond portfolio, and with everything else being irrelevant.
Dylan, I'll tell you, if I had purchased $100 million of bonds since January 21st, I'd be screaming for a Fed rate cut.
I mean, hey,
you and me both.
I want for Christmas. So I want for Christmas, right? You know, what if Trump was out here demanding rate hikes and you found out that like Trump has purchased more than $100 million in puts on TLT since taking office?
He might have.
Right.
Might have.
Right. So I mean, like, listen, we're gonna get our cuts.
He issued a meme coin right before the day before he was inaugurated, and he started a mobile phone company at the same time that he issued tariffs on Apple
and sneakers and Bibles and you name it. We got it for sale, baby. What do you need?
I'm just saying, we're getting the cuts at some point. The man's got a bigger trade on the
the latest thing was his and hers cologne. What do you need?
I think you're getting rate cuts next month.
We don't need to chew on this, guys. He purchased $100 million of bonds. The man's expecting lower rates.
Yeah. I mean, what are we even saying here?
You know what? We don't need to say anything else. With that, overtime's out of time. We'll be back next week. Well, at least Ilya and Dylan will be Monday through Thursday for 4 p.m. Eastern, 3 Central, right after last call. I'm on vacation, so you guys enjoy them. Other than that, though, Ilya, I will be with you on Sunday night for first call, and you and I are together tomorrow for Futures Power Hour, which is going to be on the heels of Powell's speech. So we'll have plenty to talk about and see how right or if my luck continues for the past 3 weeks, how wrong I'll be. So for Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Good luck trading. Stick around, though, after a brief break. Tasty Live continues at night, first with Ilya and Macro Money. Good luck trading. See you there.
See you there, everybody.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, Two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
So Tom, what is your definition of underwater?
The futures close 15 minutes after the cash markets close. So underwater means when the futures close under fair value, under the cash price.
If you're selling in the hole, what are you doing?
Oh man, if you're selling the whole, you're puking. That means you're selling it at a price you don't like, but you have to do it because it's hurting too bad.
Tom, in the pit, when somebody would say it was an out trade, what would that mean?
An out trade's a mistake. That means one person thought they were doing one thing and the other person thought they were doing something else. And so an out trade is just another word for mistake. You can use an out trade in anything in life. When you just have a misunderstanding, that's an out trade.
When Tom says double whammy, what does he mean by that?
Ooh, double whammies when you roll down calls because the stock's going lower, and then all of a sudden the stock goes higher and you start rolling up puts, you're getting double whammied.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
I literally spent like $2,000 to paint my car from red to black, and then like a year later, I didn't have the car anymore.
What's the most financially irresponsible thing you've ever done in your life?
Oh, yes. Okay. So when I was like 16 or 17, I was working at Jewel Osco. I was pushing carts. I was making like $7 an hour, $8 an hour. But for whatever reason, I decided my car had to be painted from red to black. So I worked for like 6 months. I literally spent like $2,000 to paint my car from red to black, and then like a year later, I didn't have the car anymore. So I worked for 6 months at Jewel pushing carts to paint my car for literally no reason. And that was the most irresponsible thing I've done. So don't let your kids do stupid shit like that.
What kind of car was it?
It was an Acura Integra.
Just buy a lot of near-term weekly options. If I had a $100,000 account, I was long like 20 grand's worth in the front month for sure. Don't do it, kids. Don't do it.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
It's another down day for the markets, the fifth in a row, as we get ready for the week's main event, the speech from Fed Chair Jerome Powell at the Jackson Hole Symposium in Wyoming. So what is it that we saw that got the markets in such a sour mood before the speech, and what is it likely to do? That's what we're going to unpack here. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to start with, as we typically do, is a look at the price action to see what it was that the markets were telling us here today in the most direct way possible, the prices themselves, and then consider where we go from here. Because the message now, of course, is going to very critically depend on a subjective reading of what the Fed chair says. So, episode 2 of this week's Event Risk. Episode 1 was the FOMC minutes. We had a little bit of an intermission with the PMI data to reset global growth expectations over the past 24 hours. We'll start there. And episode 2 closes the week. So, what did that intermission give us? Here's the price action for today. S&P down 0.35%, NASDAQ down 0.44%, gold down, dollar up across the board, Bitcoin, the risk appetite on steroids version of risk sentiment, essentially stock markets plus wanton speculative fervor, that's down 1.74%. This could not be a clearer sort of layout. Now, crude oil is maybe the odd one out here, but crude oil has been the odd one out from the macro narrative for a long time at this point. And it seems still to be generally stuck in the same kind of 62.30, 63.50 area that has been basically the center line going all the way back to, let's say, September of last year, as we were carving out the big and broad range on crude oil from somewhere around $74 a barrel down to about 54. The middle kind of oscillation axis for that range is somewhere in the vicinity of about 63.5 to about, let's call it 62. And so, and that's on the new incoming CLV contract for October. So crude oil is kind of on its own ride here. But aside from crude oil, the landscape could not be clearer. We very transparently see here. Rates went up. Risk appetite didn't like it. The dollar did. In an environment where yields are up and the dollar is up, gold weakens. So very straightforward. Gold doesn't yield anything. That makes it naturally something that weakens when the dollar and yields go up, because no one needs a zero interest bearing fiat alternative when interest rates and fiat, which incidentally is a yield bearing instrument, are going higher. So very clear cut here. Looking at the price action for the S&P, here's those 5 days of sell-off. And I bring up the chart and not just the performance, only to say that we haven't really had a meaningful move higher for the stock market since this right here. And that's the US CPI report. And all that report showed was that inflation was not as hot as feared. Not that it wasn't rising. In fact, core inflation went up to 3.1%. That's meaningfully higher than it's been in quite a while. As a matter of fact, 3.1 is the hottest that we'd seen since February. But the headline held at 2.7%. That's the highest again since February, but the expectation was we'd go up to 2.8, and that didn't happen. Moreover, the markets looked at goods inflation contributing just 0.22 percentage points to the headline, and most inflation still in services, and said, oh, well, good, the tariffs are not as bad of an influence on this as we might have feared. But of course, that 0.22% is also the biggest contribution from goods, and we'll get to that in just a second, that we've seen since June of 2023. So that inflation is creeping. But the markets looked at this and said, oh, well, goody. We're going to get our rate cuts because this inflation is not that bad. And that was good for a one-day rally. The 3 days thereafter do nothing. And of course, since then, we've come down. It's a soggier story for the NASDAQ, which also has the same one-day rally. It's then soggy for 4 days. We then sell off. So really, since that CPI data, stock markets have not been able to go higher. And it's because what we seem to have in that CPI data is tenuous at best. It is the sense that, oh, well, maybe, just maybe, we'll get some meaningful easing. And that seems to be the only thing that's really motivating these markets. So we look at these charts to say, if you want to see what's actually important to these markets, it is not this or that earnings report. It is not this or that comment from political leaders or this or that conversation geopolitically around the current wars, either in the Russia-Ukraine theater or the Israel-Hamas theater. It may not even be per se the comments that we got from Sam Altman this week, the CEO of OpenAI, likening the current AI situation to the dot-com bubble in 1999-2000. It seems like the one thing that's getting these markets out of bed is hope for rate cuts, and otherwise, they can't be bothered. So, what was it that set them off today, if this is our lens? Well, not surprisingly, we get a downshift in Fed rate cut expectations for September. Now we're looking at just 73.6% chance that we're going to get this cut. That's down from an absolute certainty that we're going to get it when that CPI report comes out. That certainty moderated to something in the low 80% over the past week, sort of hovering around 84, 82, 83. Today, we take a meaningful step down. And now we're basically looking at a 70-30 spread. A little bit more in the direction of a cut. Why did this happen? Well, we were looking for the PMI numbers to come out, and boy, did they ever. And we have not just the US here, but the entire landscape that came out overnight across the major economies. And the story across the board is one of better than expected results. In Australia, manufacturing, better. Services, better. Composite, better. In Japan, better. Even though you get a little bit soggier on services and manufacturing is still in contraction. Things are slow, but it's faster growth than the prior month. In the Eurozone, again, soggy, but better than expected and better than before. In fact, across the board, manufacturing actually comes out of contraction mode. In the UK, better. Manufacturing is a little bit soggy, but services really powers on, and that takes the composite higher. And then, of course, in the US, again, better. The composite is higher. Manufacturing absolutely surges. After a couple months of contraction, it surges to powerful growth. Services, a tad soggier, but only just a bit. And when you look at where we are, we can see that really the composites change was not that massive, but it's almost completely powered by manufacturing rebounding here. This is really the story of this report. And of course, from a tariff perspective, it suggests that manufacturing is, at least from this vantage point, isn't being meaningfully hampered. And so what we've done is we've essentially returned on the overall composite reading here back to these heady levels from the second half of 2024, where we had the strongest growth at one point than back here in 2022. We're not quite there yet. We're sort of closer to early 2023 levels, but nevertheless, we're near the top end of where the growth range has been for the past 2 years, looking at these numbers. So not surprisingly, the market judges, well, in this kind of environment, we don't really need the kind of rate cuts that maybe we thought were necessary were we in some kind of a downturn. Lo and behold, Fed rate cut odds come in. But what's interesting is that the markets don't look at this and say, oh, goody, a stronger economy. They go, oh, no, this derails rate cuts. So if we look at this breakdown that we've seen, and this, of course, stems from our kind of three-legged stool view of global growth, where 58% of global GDP comes from just three economies, the US, the Eurozone, and China. And then the rest of world, 42%, are mainly vendors that depend on the big three for demand because they export there. So think all of Central and Eastern Europe and the Eurozone. Think Australia and New Zealand, Southeast Asia, the commodity exporters of Africa and Latin America in the case of China. Think Canada, Mexico, indeed China itself in the case of the US. So we have a very disproportionate sort of story here for global growth, where it's really just these three economies that are driving the boat. And so when we look at the breakdown for these PMIs, then we're back into this world where Europe is getting a little better. We don't have updated August numbers for China yet. We'll see what those look like. Certainly the pickup in export orders baked into Australia's numbers are interesting in this sense, although it looks like it was mainly Europe and the US that drove the pickup in that demand. But of course, China is Australia's largest export market, so maybe finally there's something stirring there. But we can see that both China and Europe have really been hugging this center line. And of course, as ever, this is in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Europe is still kind of soggy here, although we can see clearly it's doing better. China has been stuck in a deflationary spiral for now essentially a year and a half, or 2.5 years, excuse me. So we're looking at probably more standstill when those numbers come out next week, although we'll see. But it's clear that this has become a one-engine kind of boat, where the U.S. is doing all of the heavy lifting. And so, not surprisingly, this is not an environment where the central bank might be motivated to cut, but also it's an environment where the markets very much want for there to be cuts, because operating in a world with a single point of failure is scary. And it would be good if that single point of failure had some padding and some support around it to make sure it doesn't fail if everything else can't really be a safety net. And so when you look at Fed policy expectations, they narrow in right alongside this conversation about the likelihood of cuts in September. So just like this has come down from about 83, 84 to now 73, 74, which is, of course, a meaningful swing for one day. So, too, the outlook for 2025 cumulatively is now into 42 basis points. That's obviously not in the same direction as what the Fed itself, even in all of its reluctance, has been forecasting. It is in fact on the hawkish side of that. But then what happens at the longer view, at the view for next year, is we go back out to 72 basis points, so a near certainty that we're going to get 3 cuts next year. That's, of course, very interesting to line up with what the Fed is saying, and really the essence of why this incoming event risk seems to be such a big deal, and why the markets, given data showing them a better view on global growth than they might want, ends up saying, you know what? Yes, growth is good. Yes, it's good for earnings. All that positive. We don't like it. Risk off. The Fed's latest forecasting for June has 50 basis points for this year. We can see here that the current rate is 4.25 to 4.5. The midpoint there is 4.4. And so from 4.4 this year down to 3.9, that's 50 basis points. For next year, the market has 3.6. That's only at one rate cut, from 3.9 to 3.6. That's 1/4 percentage point rate cut, sort of rounded off. So 0.25, but rounded off to 0.3 since we only have one decimal spot here. So what does that mean relative to market forecasts? Well, the markets think that maybe even that 50 basis points is questionable at this point. So if we look at what we have here, it's 17 basis points beat into a second cut, and that's only a 68% chance, even lower than what we currently are looking at for September. So the likelihood that that second cut happens relatively flimsy now versus, let's say, even a few days ago, where both cuts were fully baked in. And at 72 basis points, we are only 3 basis points shy of pricing in a third cut. So for next year, it's 2 cuts fully baked, 88% chance of a third. And the market thereby is much more dovish than what Fed officials are saying. So the markets looked at this positive data today that gave us a better view, not just of the US economy, but of the global economy, and said, right, this means fewer rate cuts now, which will mean there will have to be more rate cuts later. And so that starts to tell us what they want to hear from the Fed chair. Now, ostensibly, the Fed chair's conversation is about the labor market, but the labor market is a conversation about inflation because the things actually occurring that are Fed relevant in the labor market are suddenly the sort of execution of what is now becoming a bipartisan skepticism of immigration, as well as the demographic shift going all the way back to pre-pandemic, that is the aging out of baby boomers out of jobs, and the cohorts that follow them being smaller, and that being a story about reduced labor supply, which of course increases the price for labor as anything scarce and translates into inflation. So what this conversation looks like will be what to do about a structural inflationary environment whereby interest rates probably have to be structurally higher than they've been in the preceding 40 years, from let's call it the early to mid 80s through to the pandemic, or maybe a little bit earlier, about 2017, which was a story of perpetually lower inflation and perpetually lower rates to match. Now, we heard already from the minutes in the minutes from the Fed's July meeting, we just had them earlier this week, that a majority of participants in the FOMC meeting, so the majority of Fed officials, see the upside risks to inflation as a greater concern than the downside risk to employment. We likewise see that they expect that the current Fed funds rate is not far above neutral. That is to say, there is not that much room to cut. And worrying about risks to long-term inflation expectations, even though they expect low economic growth in the second half of the year. So, if the main disconnect for markets is this right here, if this is, let's say, you could squint and 42 basis points and is close enough to 50, maybe we'll fight that battle somewhere in October and December if the Fed decides it wants to do the second cut or not. After all, September still is much more likelier than not to actually occur, though it's down. Then the real question is, okay, well, what happens after? This is where the disconnect is, to the tune of almost 50 basis points. And if this is then the message, there's vulnerabilities from elevated asset prices. That's not a recipe for rate cuts. The current rate is not far above neutral. Whatever cuts there are going to be modest. Growth might be low, but we're concerned about inflation expectations. And indeed, the inflation risk is greater than the employment risk. All of that together tells you, okay, maybe we'll sprinkle you some rate cuts near term. But if you thought there's an extrapolated rate cut cycle, you need to change your mind, because that's not coming. Moreover, we can already see that inflation pass-through from the tariffs is starting to occur. As promised, here's a view of goods inflation. Yes, it is still much lower than services inflation, but the trend in goods is higher. The trend in services is, let's say, flat-ish. And over the past month, services inflation actually came in, goods inflation came up. Wholesalers are starting to pass through tariff costs to consumers. We saw the producer price index surge to reflect expanding wholesalers' margins on that score. Consumers have noticed their inflation expectations are up in the last consumer confidence survey. All of these things suggest the Fed is not there to jump out the window on rate cuts. And yet, this is still where the markets are. So the stage seems to be set for disappointment. And if this then is what disappointment looks like, at least in microcosm, then a Powell speech that sounds more hawkish than the markets have priced in and want to see, more so about next year than even what's going to happen through the rest of 2025, well, then the story for stock markets starts to look like it's going to remain grim. Rates look like they might continue to tick up, although to the extent that more and more easing is pumped into the long end, bonds at the long end might do meaningfully better than at the front end. The dollar probably has more room to rally. Gold probably has more room to sell off. Bitcoin may stay under pressure. And that is Macro Money for today. We are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. That makes it the last show for this week. Macro Money is, of course, back on Monday. I'll be there for Futures Power Hour on Friday tomorrow after the Powell speech to break it all down with Chris. I'll be also on Futures Power Hour as ever, Mondays and Fridays, as well as on First Call with Chris and with Tom on Sundays. Writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
We're going to go to New Orleans. I got to be in New Orleans. What's up?
Y'all three guys, just the whole organization is just phenomenal, and it's changed my life. And I wish more people would just sit back and listen to y'all and take it seriously, because it will change your life if you enjoy trading. I don't know if I could ever repay any of y'all for this free advice and free teaching y'all do. Is just remarkable. Tom, I got your hat on, and ever since I got it on, I've been blowing the market up. So make sure you don't give one to Tony or Scott, because I don't want them to benefit from us.
That's okay. Good job out of you.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
The future of trading is here.
Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. Today's been a little bit of a quieter day from the last couple of days, but we'll get into all of that and some of these headlines that are popping off right now. How we doing so far today?
Yeah, it has been kind of a quiet one. It's been a loud one for me because Paramount is moving.
It's been a loud one,
which is always good. I am fairly deeply long Paramount. My 20 calls, which are like north of 365 days to expiration, have already 5x'd. So we're gonna see how much we can do on that front. So yeah, good day for me, but yeah, feeling good. It was kind of a quieter one. We've had just a little bit of turbulence. We've had I guess what I would say is turbulence for 2025.
What are you turbulence for 2025?
Yeah, earlier this week. But yeah, I'm feeling good. Ready to talk some Cracker Barrel.
Cracker Barrel,
our topic for today.
We'll get into that for today. Hope everybody else is doing well. No Paramount for me. Got long some Apple, or threw on some long Delta in Apple today. Kind of buying a little bit of the dip. I'm still a little bearish, so got some more bearish positions, but wanted to get at least some long Delta on to take advantage of this dip, because it's felt like, especially in the beginning of April, if you don't take advantage of the dip, that dip might not come for like another month or two. I don't know what it holds for the rest of the year, but I wanted to take advantage, get some long Delta on, and that was kind of the story for today on this end.
Yeah, there's certainly some individual names. It's always, especially in like a longer dated context, it's always scary to get long the market against this type of upswing that we've been seeing. But if you were sitting around and waiting this entire time, that's going to hurt you too. So there's certainly some individual names that I think are too overextended. But I'm staying long Delta until proven otherwise myself. Has been my sentiment.
I hear you.
But yes, the barrel has cracked, everybody. Cracker Barrel announced a new logo today. If you haven't been living under a rock, I'm sure that you've seen it. It's been the talk of the internet today, and we're going to continue to perpetuate that here. A set of sweeping changes has been coming through over the last year and a half since they got a new CEO at Cracker Barrel, and this logo seems to be the pressure that has blown the top off of this volcano of everybody that is upset with these changes. So excited to get into it. First and foremost, here is the new logo. They've gone a little bit modern minimalist, as is very popular across corporations, restaurants, you name it these days. And people feel that they took a lot of life out of this logo. What do you think?
I agree that it takes a lot of life out of the logo, but I think it was necessary. I think it was needed. We'll get into it a little bit more here, but I think the uproar is also not called for.
I agree. I think the market reaction is certainly too much.
Yeah.
I mean, they lost $200 million.
$250 million
in valuation this morning after this news broke, and because of a logo, I'm not seeing it.
Yeah, we'll get into the details in some of those slides here, but in terms of the logo, in my opinion on it, I mean, I think it's cleaner. It looks a little bit better. I will say, from a perspective of if I was a Cracker Barrel goer over the last decade or whatever the case might be, maybe I might feel a certain type of way about it. But when I look at it from a business perspective, I'm like, that's a way better logo. Not as fussy.
It's interesting that you say that. I mean, a big part of the turbulence here is that Cracker Barrel has always been old school. So that's what a lot of people are pushing back on here, is that other companies, you are constantly trying to modernize, and it's almost always a better decision to modernize your logo. And it's interesting. I always think this with cars. Somehow after 10 years, cars always look dated. They have it down. Somehow they always.
My mind went to cars first too.
Yeah, they make enough subtle tweaks that if you look at any 10-year-old car, you can tell it's 10 years old, which is always interesting. But in the case of a company like Cracker Barrel, where being old school Southern hospitality was kind of your brand, I can see where the pushback is coming from. But yeah, ultimately, I don't think it's the end of the world. Did somebody ask? Oh, some people don't have Cracker Barrels where they live.
Really?
What is this place? Says Sleeping Mocha. Cracker Barrel is a Southern comfort restaurant chain. They also have stores built into the restaurants. The idea is that it feels like a old school Southern, or I guess Western, I'm not exactly sure how they would classify themselves, diner sort of vibe. And we'll get into some more specifics of what that entails here shortly. But yeah, and they serve comfort food. It's good. I don't think I've been to a Cracker Barrel in some years, but I've never had a bad experience at one. It's a fun experience. They have an interesting business model where they use the restaurant to get you in the door, and then they try to flush you into the store.
Yeah.
And have you buy some stuff as well. So yeah, first thing we got to cover here. I'll let you take it over.
No, actually, go ahead. Go through the slides. I got the.
I got you. Yeah. So this Julie Fels-Massino took over as CEO of Cracker Barrel on November 1st, 2023. She's had an illustrious career in the restaurant industry and I guess in business as a whole, but particularly in restaurants. She jumped over to Cracker Barrel after being president of Taco Bell for 3 years, managed it through COVID. Is she the reason the chicken Chipotle melts aren't $1 anymore? I don't know, but if so, I'm not very happy about it. She was the president of Fisher-Price before Taco Bell, the toy company under Mattel. But before Fisher-Price, it was Starbucks, and she also currently, right now, while she is CEO of Cracker Barrel, is also on the board at Vivid Seats, which I thought was an interesting tidbit. And she has done all of this with a BA in Communications, Bachelor of Arts in Communications from Miami University in Ohio, which is quite something. It's quite something to do all of this with just a undergrad level degree, and it's quite something beyond that to do it all with a communications degree.
You know what it's reminding me of right off the bat? What does that story remind you of that we just talked about? Target.
Oh, Target?
I mean, like from the bottom, now we're here. Like 2 stories back to back.
Yeah, it's true.
Working their way up.
Yeah, the Target CEO, Michael Fidelki, he worked his way up internally. She has company hopped a whole lot to whatever is most conducive, which, that's respectable. Nothing wrong with that. But to be fair, she was at Starbucks for 12 years at the very beginning. Yeah. Worked her way up to a good level there and then began hopping around to whatever roles suited her best. But yeah, clearly some experience in the restaurant industry with successful restaurants that were successful while she was there. But so far, it has not been great news for Cracker Barrel with Miss Fels-Massino at the head.
It's been tough. They've been dogging on her on socials. I'm not even gonna lie.
Yeah.
She's been taken through the ringer from what I've seen so far.
Yes.
I think that's it's a tough position to be in. Any type of decisions being made at that level, like you're gonna get some type of criticism. And I mean, with such a core, I think Cracker Barrel has such a core community. Like you do have to be careful with alienating a lot of that core community that you have right off the bat. And I think no matter who was in her position, if they were going to make those type of changes, they were going to catch a lot of flack. So it's a tough position to be in.
Yeah, and Cracker Barrel definitely had the definition of a cult-like following. People really love this place. My grandma is a Cracker Barrel.
Well, that's what I was
enthusiast.
That's another thing I was gonna say. And we can jump to the next slide.
Yeah, we can. I have to take a sidebar for chat here because
all good.
You guys are making me laugh. They should merge with Waffle House. That's an idea. Those, I think the customer, service experience.
That would be the funniest merger of all time.
That would be so funny.
That might be good for our country.
It's like low key, like same target demographic as Waffle House, but they could not be more different.
Yeah, a bit different.
Yeah.
What a merger. Anyways.
Yeah.
That's a content.
And then if you like biscuits and gravy, Cracker Barrel is your restaurant.
No
Absolutely.
doubt. Biscuits and gravy are fire.
Absolutely. Chicken Barrel. I don't know how we got started on this Chicken Barrel thing. Everyone's playing off of this. But yeah, and also, fun fact Errol and I learned before hopping on air, a Cracker Barrel, the actual thing, was that in old Western stores, they would restock the stores with a large barrel of crackers. And when the cracker shipment came in, the Cracker Barrel, it was like an exciting thing, and lots of people, like after work in the evenings, would gather around the Cracker Barrel and smash beers and eat crackers to their heart's content. Because that's what you did for fun.
With the boys.
That's what you did for fun in the late 1800s in the United States.
Yeah.
And you all just smelled horrible.
Yeah. Terrible.
Terrible.
I mean, terrible. I'm assuming.
Yeah. But anyway, we can keep pushing here.
Yeah. What do we got over here? So, I mean, we got the new logo. We got the new design. And obviously, right off of the bat, I mean, we got the left side is going to be the old style version of Cracker Barrel. And then the right side is going to be the new design. I got to say, I'm not mad at new changes. I'm not mad at things adjusting and adapting. But personally, the older style does have a better feel to it, in my opinion. I mean, I feel like on the right side, I'm looking at a Wendy's right now.
I agree, because the right side, I think I get the same vibes. It's like a Wendy's or just any kind of popular fast food chain, and it's like, what are you trying to do?
Right.
Because this feels like two in the middle. This thing that we're doing on the right, you can't try to split the difference. If you're going to modernize, and you can figure it out from there. But this thing on the right, I mean, it looks like, which to be frank, it kind of is, somebody who has never spent a day in the South's interpretation of what like a Southern restaurant might look like.
Not even in like a modern way. Like I've seen some of these older vehicles, or I've seen, you know what I've actually really liked lately is they're starting to recreate a lot of these like old kitchen appliances like the look of them, but like with modern tools and modern materials. And I was like, yo, I love that, because sometimes the old style look is goated and it's fire, but like modernize that with like the newer materials, the better quality materials. And it's like, I think Cracker Barrel could have taken that approach, that direction, maybe just modernize things a little bit, but like keep the core, what's it called? The core character of the company there. But I mean, they pretty much ripped the character out of the whole company, because if you weren't going to Cracker Barrel before this rebrand, you don't know Cracker Barrel, if we're being honest, looking at that second picture.
Yeah, and I mean, legit, walk into your local Culver's, and it's going to look exactly like this picture on the right. 100%. And it's just, I feel like they gave up a lot of that like sit down restaurant kind of hospitality feel that they had going for them. I'm seeing similar sentiment in chat. Cool design, I hate it.
Cool design, I hate it.
Yeah, but precisely, I'd rather sit in a wooden wagon. Hell yeah, big deal. So yeah, and this is a sprawling sweep of changes additionally, which we don't have a pointed slide for, but they've made changes to the menu as well. They're working to modernize the menu. What the hell does that even mean? How do you food? I don't
modernize the menu. Like, we're using salt now. Using new seasoning.
Did a new seasoning update drop and I missed it? I don't understand what that even means.
Hey, the old Cracker Barrel been patched.
They patched old Cracker Barrel. I hate the new release. Playing offline so I can have my old Cracker Barrel. Anyway, so share price impact. This is the short-term share price impact. These are 10-minute candles on a 3-day time frame. So you can see the steep fall off. This is just today as a result of this logo. Nothing else happened. Like, I cannot stress this enough. They lost $200+ million in valuation this morning because of a logo. That is all that happened. So yeah, huge sell-off. It was down 13% at the very peak, down in this range. And then it rebounded a little bit throughout the day today.
I mean, subjective, but what an overreaction.
Yes.
I mean, guys, let's be real. I admit, I'm not against, revamping the logo. I can admit the newer modern design inside literally looks like any type of Culver's or Wendy's you might go into. But from a business perspective, does this really warrant a $250 million loss in value? I don't really think so.
Yeah, no, I agree. I think it's an overreaction. Nothing has changed about the fundamentals of the company whatsoever, and this is purely a reactionary thing. And I will note that the reason that everybody is so upset about this, and the reason for this big overreaction, and I am not making a political statement here, I am reporting the facts, is that lots of people perceive these changes to be woke, and perceive this CEO to be woke. I have seen the Bud Light comparison thrown around a number of times today.
I got some thoughts on this.
Yes, yeah. And people feel that this is just another step in this woke progression that is going to destroy Cracker Barrel. Those are the facts, and that is why it is sliding. I'm not taking a stance here.
I will say I think that's kind of dumb, right? I get that does happen, I think, in certain areas, but for the Cracker Barrel situation, I don't think somebody's going to revamp literally the entire company. I think it was more so just done through a business perspective, because at the end of the day, I think this conversation that we're talking about and the semantics that's being argued over because of this is not going to exist, in my opinion, in 60 days from now.
Yeah, and I think that, and yes, and that's the other side of this equation is, and I see the Bud Light comparison all the time. Bud Light is totally back now. It didn't matter in the long term at all. It totally recovered, and it's fine. And I'm sure there's still some.
It's because they're three deep. They forgot.
Yeah, and I'm sure there's still some hardos out there that are still on the Bud Light boycott. But holistically, that has died. Their sales have recovered. It's not like that big of a deal.
Yeah.
And yeah, I just don't see it. Now, I will say there is some credence to saying, oh my gosh, you're making move after move after move that alienates your core demographic that was a cult-like following, and that's problematic. And I can absolutely see that angle, and I don't even necessarily disagree with it. But at the same time, this is a logo. If we were going to do this, we should have done it when they redesigned the interiors, because I feel like that's a much bigger change.
I completely agree. It is a much bigger change.
Yeah.
And then over here, they were saying it's looking like they're trying to make a whole new restaurant, which, I mean, that does look exactly what they're trying to do.
That's absolutely true. Yeah, you're trying to abandon your model and do something completely different.
Yeah, so I think if you're in the mindset of like they're trying to keep things the same, then you might be like, okay, this is really dumb. Like, even I would be of that sense of like, why would we take out the wooden chairs? Like, even just the wooden table.
Yeah.
Those are gone, which were like the staples of Cracker Barrel. So I think what that company is communicating.
And the core issue is that nobody goes to Cracker Barrel looking for modernity. In fact, it is quite the opposite.
That's quite true.
People go to Cracker Barrel for nostalgia, for the same experience that they've been having since they were kids, and that hometown sort of Southern comfort kind of feel. And so, yeah, switching up on that, it's sort of abandoning your core identity as a brand, but that doesn't mean you can't continue to be successful and that this pivot won't work.
I mean, the food is literally going to be probably it's a new menu, huh?
Yeah, I mean, they added things.
So people,
They didn't completely.
Yeah.
Yeah.
But I mean, you're still going to get Cracker Barrel food.
Yeah.
So
No,
at the end of the day, it is semantics because it is known for its food, but.
Yes. And I saw a comment I wanted to mention over here. Oh yes, Laid Back Trader said, "LOL, poor graphic designer." Yes, this is something that has crossed my mind a number of times today. Is that this poor graphic designer is out there somewhere and was simply instructed to make a new logo. They don't have any power beyond that, and now their logo is getting ripped to shreds by the masses. And I do feel bad for that individual. I will say. But anyway. Long-term share price impact, zooming out a little bit here. These are weekly candles in the time period since Fels Mazzino. These double last names, it's a little challenging, guys. Since Miss Julie, I don't mean to disrespect her, I just can't pronounce her names, took over. So November 1st, 2023 is the furthest left on this graph, and I will note that is kind of an approximation because November 6th was the closest date that would show up, but I think I did pretty good. And yeah, share price is down almost 20%, 18% and some change is the final number. It would be a full 20% had this closed at the same price that it opened at today, but the rebound brought them back inside. But yeah, this is not a good run, and especially when you're talking about the sample size growing larger and larger. We're talking about 20 months of sample size now, 22 even, which is rather substantial.
No, I mean, like we said again, it does feel like it's an overreaction in the short term, but I mean, they've been still doing pretty well. After the, considering the aggressive sell-off in the morning, I mean, the recovery into the afternoon is looking pretty good. But more headlines when I was doing more research. I mean, that CEO, she's been getting just thrashed through the headlines. And I know even over here, we're kind of doubling down on that. Like, the stock price has been down ever since she's been in there. But, hey, trust the process. Trust the process. Let's see what she does. Maybe things do turn around.
Yeah, and this is a great point. This being made in chat here is that McDonald's used to be lit until recently. I mean, they used to be big, colorful, lots of stuff going on.
Every McDonald's had
play place. Yeah, and now they've stripped the play places out completely, and all the buildings are just like boring gray and white, modern looking McDonald's.
And if anything, I feel like there was one era where most of the fast food chains went through that. Like, I feel like you started to see like, oh, Wendy's looks modern now. Oh, Burger King looks modern now. And it's like they all use the same developers to modernize everything.
Yeah, and Theta Trader, he said, Bud commercials are trying, but the tattooed white rapper whose name I forget just looks like it'd give you an STI by standing in a 20-foot radius.
You're either talking about Pete Davidson or Eminem.
It's Post Malone.
Oh, I forgot the third. That's hilarious. What a wild card. That fits the description perfectly.
Yeah, the Post Malone.
If someone would have said that with a cigarette, then I would have been like, Post. That's Posty.
Yeah, it's Post Malone and Shane Gillis are the new Bud Light duo.
Shane Gillis
they have all those commercials.
I think he's hilarious.
Oh yeah, I love Shane
hilarious.
Gillis. Yeah, he's really funny. But anyway.
I mean, we had some media reactions, a lot of mixed emotion, but one that really stood out right off the bat is seeing other companies take advantage of the buzz of other companies. For example, Steak and Shake right here said, sometimes people want to change things just to put their own personality on things. At Cracker Barrel, their goal is to just delete the personality altogether. Like, that's a statement for one. Hence the elimination of the old timer from the signage. Heritage is what got Cracker Barrel this far, and now the CEO wants to just scrape it all away. I know I didn't finish that, but also I think Steak and Shake was trying to rage bait a little bit.
Sure.
Right, I
will say, if any company has the grounds to talk like this, it is Steak and Shake.
Okay, why is that?
Because they've never switched up. The logo has never changed. They never made any major changes to the logo. You walk into a Steak and Shake right now, it still feels like the one straight out of the 50s. They really lean into that 50s thing. All the staff wear the little 50s diner hats, and it's just it's got that kind of feel. So yeah, if anybody has the grounds to do it, if it was Burger King or something, I'd be like, you just redesigned your logo last year. What the hell are you talking about? But Steak and Shake,
they stand on those values.
They stood on it.
That's valid. That's valid. That's valid. But I gotta say is, one thing that they really pointed out was they said their goal is to just delete the personality altogether. Hence the elimination of the old timer from the signage. Right. Just really highlighting their core demographic and be like, hey guys, do you see what they're doing? We would never do that to you guys. Like, that's what they're doing with that post. And then it says at Steak and Shake, we take pride in our history, our families, American values. All are welcome. Look, I also think it's funny, American values. Let's just call it how we see it. Cracker Barrel has more of those American values because it's a little more Southern hospitality. And I think by using certain verbiage in that tweet was just very, calculated.
And I'll say this tweet gonna go crazy in 5 years when Steak and Shake changes their logo, because it's gonna happen.
100%.
It's gonna happen.
No doubt.
It's inevitable with every company now.
Yeah.
It feels like.
Yeah.
And yeah, it's at some point the hot dog at Costco is gonna go up, and Steak and Shake is gonna change their logo, and we riot.
100%. As you can see, we got a couple more reactions over here. Some people saying I don't understand what woke is about this change. Others talking about how Cracker Barrel, you better get ready. Hopefully you recognize going woke isn't going to do something positive for your stock price. And then we have over here, I think the silliest part of the whole Cracker Barrel discourse is everyone acting like the food was good enough. This is so me. Acting like the food was good enough to care about the place before. If you're north of the Mason-Dixon, it is an overpriced mockery of Southern food. If you're south of it, you have way better options. So I didn't grow up in the South, so I can't let you know if, this is fire Southern food or not. But I got to say is when I tried it in Colorado, which I wasn't in the South, in Colorado when I tried it for the first time, I thought it was kind of mid. It's not that it was bad, but I was like, this was so average in comparison to how my mom was hyping it up. So not that it wasn't good, but the hype to reality ratio was just
Sure. I will say, and I feel qualified to speak on this, having just moved up here after a decade in Texas, that I think Cracker Barrel's pretty solid. I would agree with it in the same capacity. I think it's slightly above average, and it's super consistent, and the service is really good. And I've always enjoyed my experiences at Cracker Barrel, both with the staff and as it pertains to the food specifically. I think that there's some credence to, if you're south of it, you have way better options. That's true to an extent, but when I go to the South, like the deep South, the Texas, Alabama, Louisiana, I want Mexican food. That's what I'm looking for.
I did not see that coming.
Because
I did not see that coming.
That's like what I really think is like tiered as you move down the United States. Is I think if you could somehow map reviews, the Mexican food gets better and better and better. But I don't even think about traditional Southern comfort food when I think about Texas, to be quite honest with you. I'm just like, oh man, even just Papacitos, clears everywhere that we have up here.
I was just talking with CEO literally 5 minutes ago, and
Lupe Tortilla. Go on.
Yeah, I was just talking with CEO, and he was talking about how he's like, man, I wish I was Mexican. I love Mexican food. And then when you just said that right off the bat, 10 minutes, or just hilarious.
Yeah, but. Yeah, but I think there's some credence, but I think Cracker Barrel food is good. I will come to the defense on that.
No, absolutely. But with that being said,
also to the point, Deal Generator. By the way, you've made 6 good points here. I keep reading them and meaning to mention them. I don't think it was ever about the quality of the food. The experience is what we want.
Absolutely, 110%.
And that's a huge part of it too. And they are taking down that experience with these changes that they're making. Beyond that, I loved this one. I understand it's a business which expects to make money. However, it seems as a society we've forgotten or ignore nostalgia and focus more on instant gratification. I think that is a very great and all-encompassing statement that extends beyond even just business.
Unfortunately, though, especially, if it's not going to be financially the best move, especially with these extremely large companies, they're just not. If it's not the business best move, that's just the society I think we live in, and just the age of capitalism I think we've gotten to. So whenever you're a Fortune 500 company, I just think that they will always sacrifice the experience if it's going to bring more dollars. Honestly, I just think that's how it's always going to go. I hope other
but then you get into where are you sacrificing the experience so much that you alienate your audience and make less dollars, which is kind of I think that's concern that we're having with Cracker Barrel here.
Well, that's the thing. I think that it will alienate their core audience, but I do think this headline buzz is going to do better for them in the long term than not.
Yeah.
I think Cracker Barrel is going to start making more money than they were before this rebrand.
Deal Generator said, "Say that again so I can record it and play that clip for my wife." It'll be on the Tasty Live site right after we go off air. You can go find it. Let me make a statement. Deal Generator's wife, I, as a representative of the Tasty Live community, hereby issue Deal Generator 1 get out of jail free card for whatever he did. Thank you. All right.
Make that 2.
Oh, man. If I ever visit Mexico, I'll see if Luis can recommend a good mole. Oh, yeah.
Oh, I know he will.
Oh, yeah.
Bro, I low-key miss Luis.
Yeah, Luis, he got the spots. I know he got the spots. But, yeah, that's what we got here on Cracker Barrel. Times are changing. We are definitely in the era of minimalism as far as business is concerned.
We are.
Which... a lot of times I don't mind, but I saw a really good thread on Twitter today, and somebody posted the Cracker Barrel logo and said, can anybody show me a time when a company went minimalist with their logo and it definitely got better? And scrolling through the replies, there was 2 that I agreed with. One was Kia, when they went from the red circle with Kia inside over to the nice black Kia that they have now. And the other one was another car manufacturer, Peugeot, which we don't have any Peugeots in America. But Peugeot recently switched to a just better-looking lion head logo instead of being the full body of the lion. Thought that was good. But I saw many other people posting these compilations of 40 companies, like old to new logos, and holistically, it often is like you give up a lot of character.
Yeah.
In that. So yeah, it's interesting. And design is always, it's always. What am I looking for here? Seasonal, cyclical.
Adaptive.
It's a cyclical.
Yeah,
design is a cyclical thing. Like if you just go out and drive around neighborhoods, you can easily point at houses and say that house is definitely from the 50s. This house is definitely
100%.
from the 70s. And so yeah, things are always turning over, and perhaps we will get back to a maximalist sort of design phase here sometime in the next decade.
And you know what I always thought of? You know how like that modern design, that contemporary modern design is a little bit more popular with our youth? I'm kind of just thinking about like when that modern design is going to start feeling old. It's very modern, the sharp edges, clean this, clean that, but when is that going to pass to where modern is like the older kind of feel design?
Yeah. No, yeah. And it's interesting. And it's just interesting to see how things age. And yeah, like I said, I mean, cars and buildings too. I mean, architecture to an extent, you can always tell when something is a little bit old. And it's just interesting how things evolve, and we're always just accepting the new modern.
Yep, yeah. Anything else before we hop on out of here?
No, don't got anything else. Thought this has been a great conversation. Thanks for being here, everybody. You guys,
it was a great conversation.
This has been. You guys have me laughing in this chat. I appreciate you.
We'll circle back around to Cracker Barrel. We'll see how they're doing tomorrow into the weekend, and then even into next week. I think it's going to be a fun underlying to kind of keep an eye on.
Oh yeah, and actually, huge note. Can't believe I forgot to say this. It's on the follow page. I'm long Cracker Barrel. I bought Cracker Barrel at the very bottom today because I am not buying a $250 million loss in valuation because of the freaking logo. Yeah. The position looks good. I am long Cracker Barrel.
Gus just said he's woke. No, I'm just playing. I'm just playing. That's going to do it for today's segment. Thanks for taking the time to hang out with us. Be sure to stay tuned for more coming on next, and we will catch you guys next time. Peace.